Hello everybody, Charlie Gipple here, the CEO of CG Financial Group. Do you know that there are speed walking Olympics? There are actually competitions on who can walk the fastest. How do you do that? What constitutes walking? What constitutes running? When do you get disqualified? How do you know when you're crossing over that barrier? Obviously they're much more in tune with their bodies than I am because I would be disqualified. The sad part is I'd probably still be running and they would still beat me by speed walking. But isn't that kind of like being the tallest elf? Speed walking. How does that work? Now, how do they know when they're actually running? I don't know how they know when they're actually running, but I will say in the life insurance space, there is a clear delineation between walking and running, and allow me to explain. I'll start this video with a quick question and then I'll make a statement, then we'll get into the meat of this. The first one is the question. Have you, Mr. Financial Professional, Mrs. Financial Professional, ever come across a lump sum of money, a chunk of money, not ongoing premium, but rather a chunk of money that you know that client would have a better use for that money in a life insurance policy than, say, a single premium annuity? Have you ever come across that scenario? How do you put it into that life insurance policy to still have the tax advantageous benefits that life insurance possess? Secondly, a statement. The statement is, it is not as simple as taking, say, our $40,000, in my example, chunk of money, and dividing it into 7. I get this all the time. Oh, let's 7 pay an indexed universal life insurance policy. It is not that simple. Fortunately, it is not that simple in that there are more efficient ways to do that. There are better ways. There are ways where you can walk faster without actually running. Running being what we don't want. We don't want a modified endowment contract, right? So let's get into the meat of this, is how do you determine how fast you can fund a life insurance policy, specifically IUL for purposes of our conversations today. And by the way, this is not one of those nice, fluffy, mental gymnastics, niche-y conversations that I'm having today, because maximum funded indexed universal life insurance is around 80% or so of the $2 billion business that is indexed universal life insurance. Around 80% or so of the IUL business is for the purpose of accumulation, i.e. max funding life insurance. So this is the real deal. It's not just talking about some nice niche-y thing just so I can talk about stuff that doesn't matter, right? All right, so talking about life insurance, all else being equal, the goal is to cram in as much money as possible, as fast as possible. Why? Because of time value of money. If you have $40,000, that $40,000 going in as just a single premium, that is going to grow faster than $40,000 spread out over, say, a 20-year period of time, right? This is Finance 101. Wouldn't it be beautiful if you can cram $40,000 into a life insurance policy? Heck, wouldn't it be beautiful if the death benefit was only $40,000? Basically, the cash value equaled the death benefit. The net amount at risk is 0. Therefore, the cost of insurance charges were 0. Wouldn't that be beautiful? Well, you can't do that. Why? Because of these things back in the 1980s, TEFRA, DEFRA, and TAMRA. TEFRA and DEFRA defining life insurance, and TAMRA defining what a modified endowment contract is. So what did these things do, this legislation back in the 1980s, what did it do? It basically said, yeah, once you pass this level of funding in the life insurance policy, you're not speed walking anymore. You are running, and you are disqualified from the life insurance tax-free loans game is what it is. It's a modified endowment contract. Well, what's a modified endowment contract? A modified endowment contract, to simplify, is taking a life insurance policy and turning its taxation into an annuity, basically. From a taxation standpoint, a modified endowment contract is an annuity, as in last in, first out tax treatment, as in income tax treatment on that gain that comes out first, as in pre-59.5, 10% penalties if you are less than 59.5. So a modified endowment contract is basically an annuity from a tax standpoint, with one exception. And I know that many of you are already thinking of this, but Charlie, that's not true if you're a beneficiary. A beneficiary getting a death benefit from a modified endowment contract is going to get that benefit tax-free. The beneficiary does not care if that life insurance policy was a MEC or not. That is a one exception to my statement about life taxation being annuity taxation if that life policy is a MEC. Okay, so how do we cram in as much money as fast as possible without us being considered as running versus speed walking here? So here's what I did. I took a 25-year-old and I said, let's say this 25-year-old has $40,000. Talking to you, the financial professional, $40,000. How fast can we cram that $40,000 into a life insurance policy? So what you do in the illustration is you go in there and you say, single premium, just one premium, $40,000 going in, uncheck the MEC box. So we want this to be a MEC, right, for this phase of the illustration. You don't want it to protect against being a MEC because we have some data we want to gather. The illustration will print out and it'll say for that $40,000, the death benefit is maybe, I don't know, $150,000. The death benefit we're not going to focus on here because it's all about the premium side of things. Although the death benefit, my Broker World article coming out in 3 days, it is absolutely necessary that every client you sell a life insurance policy to has to have a death benefit need. And I pontificate on that a little bit in my Broker World article in about 1,000 words or so. Coming out in a few days, I talk about the need, the absolute need for a death benefit. But I don't want to talk about that part of it because this is about the premium side of the equation here today. So the codes that are going to be spit out in the illustration, those mean something. And a lot of you have probably seen these codes and like, I have no idea what the GA, what the GS, what the 7P, what all that stuff means. That's very important information. Let's talk about that. So one of the codes that's going to spit out in that illustration when we punched in 40,000 single premium may be something like this, 7P. You can surmise what that 7P means. Another code may be GS, for instance. Another code may be GA, for instance. So these two is a test basically to see if it's life insurance, which is completely different than if it's a modified endowment contract. A lot of people lump these all together. Well, if it does, you know, if it doesn't pass these tests right here, guideline annual premium, guideline single premium, then it's a modified endowment contract. Not true. It's not life insurance if it doesn't pass these tests. This is where you get into the modified endowment contract stuff. I don't want to overcomplicate that part. Guideline annual for purposes of what I'm talking about today, one big chunk of money. Guideline annual usually does not come into play. The two important ones are this and this. Guideline single premium, no coincidence. What is that going to show? Well, we entered in that our premium was going to be $40,000. So it should look something like that. Now it'll be much larger than that if you still have that modified endowment contract box checked, because then it's, I won't go into why that is, but make sure that box is unchecked and that should show $40,000. But this is the important number at this point in time, right? For my 25-year-old, what it said is that $10,746 is actually the max that one could walk while still being considered walking, right? So versus the person that calls me up, the agent, the financial professional, who says, and rightfully so, who says, well, so 40,000, we just divide that by 7, and 7 divided by 40,000, what is that? That's what, I don't even, is that 6,600? Whatever. Well, we just want to fund it over a 7-year period of time here, that $40,000, versus that. No, there is a much more efficient, faster way to put your money into the policy. You can walk faster without still running. And what is it? Say round down, for instance, say $10,000 per year, $10,000 per year over a 4-pay. Will that satisfy the 7-pay? Yeah, because you're not exceeding that. Well, the guideline single premium, you know, you're putting in $40,000. Yes, you can actually cram money into this policy faster than a 7-pay. You know, technically, if you divided $40,000 by $10,746, you can cram money in the entire $40,000 over a 3.72 year period of time. Again, round up and say a 4-year period of time, $10,000 per year. And that will show you much better accumulation than spreading that $40,000 out over a 7-year period of time. By the way, many of these companies, these IUL companies, have a premium deposit account. Now, you still kind of have to do this math because a premium deposit account says, okay, so you put $40,000 in. How How fast do you want that PDA to pay out into the actual life insurance policy? Well, our answer to that question would be 4 years. We want to do a 4-year from the premium deposit account, the holding tank, into the actual life insurance policy. And that will avoid you running instead of walking, because you want to walk in the eyes of the IRS. And that will also allow you to cram it. With a PDA, you'll actually be putting in more than $40,000. Why? Because usually there's an interest rate associated with that premium deposit account. Now, another thing is a 65-year-old. If I did the same scenario with a 65-year-old, the 7-pay premium would be less. It would actually only be $7,289, which means for that older person, they would have to spread their $40,000 out over $7,289 divided into that equals 5.48 years. Round up, call it a 6-pay for that 65-year-old. Those two my point is those two numbers are very important. And by looking at these two numbers, you will be able to determine how quickly you can cram money into that policy, leverage the time value of money, and also leverage the tax code, the benefits that gives, well, the legislation, the rules, the law that gives life insurance the wonderful taxation that is a non-modified endowment contract life insurance policy. Tax-free loans, all that good stuff. Hope you enjoyed. If you're a financial professional and want to talk with me further about this, we're an IMO out of Des Moines, Iowa. I'm the CEO of the company here, Charlie Gipple. Thank you and have a good day.